Next up, our next speaker is Ciamac Moallemi. Ciamac is the William von Muffling Professor of Business at the Columbia University Graduate School of Business. He also serves as a research advisor to both Paradigm and Uniswap.
Okay, so I'm going to talk about joint work with Wei Ji, Malesh Pai, and Xiaoqiao Wang. This is going to be in the context of prediction markets, which Danning very helpfully just gave us a nice introduction to. And what I'm going to talk about is volatility in prediction markets. But really, that's just sort of fancy language for modeling how information gets incorporated into prices in prediction markets. And so to kind of warm up with an example, here are two different prediction markets. The market on the left is a prediction market on the event of will the US confirm that aliens exist in 2026? And the prediction market on the right is a prediction market on Game 4 of the NBA Final, where New York beat San Antonio. And the thing that these two markets have in common is at the point that I'm sampling, where you see an arrow, the price is 6.5 cents. So that means roughly, let's say, 6% probability of the event happening. And there's kind of, an initial view might be that maybe that price summarizes everything we know about the situation. It's a sufficient statistic for whether this thing is going to happen or not. But I would argue not, because obviously these are two very different situations. And the way that I'd like to highlight how they're different is, how we expect new information to be incorporated. In particular, these plots are all, 1-hour samples. In the next hour, it's probably unlikely that we're going to get a lot of new information about aliens. Right? On the other hand, if you're at Game 4 of the NBA Finals and you're in the game and you're an hour before expiry, you know that thing is going to resolve to 0 and 1, right? So even though the price is 6.5 cents right now, there's potentially a lot of uncertainty in the near term about what that price would be, versus for the aliens example, there's not. And that's exactly the question of volatility. So the theme of this talk is how do we come up with models for that in the context of prediction markets. Now, before we dive into that actual question, why might we be interested in this? Well, if you're a trader and you have a portfolio of positions in prediction markets, understanding how the prices change and the statistical properties of that's exactly a risk management question. So it's very important for risk management. If you're running an exchange, the flip side is you also care about risk management. You care about things like collateralization and mortgage requirements, and maybe if you're going to provide leverage, how much leverage to provide. If you're a market maker, you care about this because sort of prices changing unexpectedly, that's exactly adverse selection. And so, for example, if you know that volatility is going to be higher, maybe you want to widen your spreads, maybe you want to reduce liquidity. If volatility is going to be low, maybe you want to tighten your spreads and increase liquidity and so on. From the perspective of a downstream user, you can view this as kind of like a flavor of, I'll call it in quotes, a confidence interval, right? So for example, if you see a probability of 73%, a volatility prediction is going to give you a number for how likely is that to be stable. Right, and so if I'm going to make a decision based on that 73%, is it going to change 5 minutes from now or not? And just at the highest level, the question we're answering is how do prices change? And fundamentally, that is how and when is new information incorporated in prices. Now, there are standard models for this. Maybe the canonical model for sort of volatility in time series is the sort of Arch-Garch models from finance. Robert Engel won a Nobel Prize for this. That might be the starting point for models for prediction markets. But we're going to argue, and I'll show you empirically, that doesn't work well because of some of the specifics of prediction markets. Prediction markets have a lot of structure that you have to factor in when thinking about price volatility. So first of all, the prices are bounded. They're in between 0 and 1. They're not kind of arbitrary numbers like a stock price or something like that. Second of all, we have a resolution in prediction markets, right? In particular, eventually, the payoff is going to be binary. It's going to be either 0 or 1. And moreover, that date is typically known, or at least there's an endpoint. Right? And all remaining uncertainty must be resolved by that date. But finally, like other markets, we also expect things like spreads and volume to lead to information in prediction markets. And those are things that models like Garch also don't incorporate. So what I'm going to do is quickly describe a structural volatility model for prediction markets that are built from these features, and then I'll show you some empirical results. So with that, I'm going to get into it. So I'm going to start with some stylized observations, some of which mirror some of the things that Danning mentioned. First thing I'm going to look at is the dependence of a price volatility on the underlying price. So on the x-axis here, I have bins of prediction market price. And over here, I'm looking at hourly observations on Kalshi over a 5-year interval. And on the y-axis, I have a root mean squared of what's the next hour kind of price move. And you can immediately see there's a pattern. Namely, when prices are close to 50-50, prices tend to be more variable in the next hour when, as opposed to when they're closer to 0 or closer to 100%. So that's one pattern. A second pattern is if we look at the time to expiry. So on the x-axis over here, I have the time to the end of the prediction market in hours. And on the y-axis, I have the same as the slide before, which is a sort of root mean squared of the next hour price move. And you can see also there's kind of a pattern here. It's not that the volatility is uniform. It's that it's more concentrated towards the end of the prediction market. So these are two stylized facts. But if you think about it for a moment, and if you go through the math of prediction markets, they're actually kind of implied by basic mathematical properties, right? And that's the idea of a variance budget, which I want to explain now, right? So let's start with the price of a prediction market, right? If we're in a risk-neutral setting, the price is the expectation of the payoff. Here, the payoff theta is going to be something that's binary, that's 0 or 1. So its expected value is exactly its conditional probability. And because the price is a conditional expected value, the price also has to be a martingale, right? In other words, its future expectation is its value now. So that's one property. Now, if I think about the variance of the payoff is binary. It's a Bernoulli random variable. So if we compute its variance is simply the probability of it happening times 1 minus the probability of it happening. It's elementary result in a probability. And that probability is given by the price right now. But I can also decompose the variance in a separate way. I can decompose it according to the fact that the price is a martingale. Right? So if I want the variance of the final payoff, I know the variance of the final payoff is the same as the variance of the final price because the price is going to converge to the final payoff. And if I write out that price in terms of price increments and observe that these price increments are martingale differences, and then I take a square and compute variance and so on, you get this identity that for a martingale, its overall variance is the sum of future per period variances. Right? So now what I'm going to do is I'm going to put together these two equalities, and I'm going to get what I call the variance budget identity, which is that any uncertainty that we have about the final resolution of the market has to decompose into uncertainty that resolves in the t minus tau periods that are remaining from now to then. Right? So the total variance has to sum up across time. So now if I'm sitting here at time t, I know the total variance up to time capital T. I'm trying to forecast the variance for the next hour. If I don't know anything and I want to just kind of have a simple model, what's a reasonable assumption to make? Well, let's just assume that the variance decays at the average rate. So we know that total variance is going to be p times t1 minus p. We know that there's tau periods remaining, so we'll just assume that total variance budget is spent uniformly. That's going to be our assumption, and guess what? That matches the stylized facts I gave you before. In terms of the dependence on price, that's in the numerator. That's going to be maximized when your price is around a half, and in terms of the dependence on time to expiry, that's going to be in the denominator, and that's going to be maximized as you approach expiry. So that's one sort of structural model, which we call the default deadline resolution channel. And this is simply forced by the structure of a prediction market where it has to be a martingale between 0 and 1, and it has to converge to 0 or 1 at the end. And of course, we're making an assumption in the last step. The second channel is to try and get information from orders. Right? And so here we're going to use a very kind of a simple Gloston-Milgram type of adverse a selection model, we're going to make an assumption about, a trader arrives. There's some probability that they're informed. There's some probability that they're uninformed. If they're informed, they buy according to the direction of the eventual resolution. Otherwise, they buy 50-50. Market makers know this. They set prices, a bid price and an ask price, according to a zero profit condition. And after a trade, they do a Bayesian update and they modify their prices. If you do a little bit of math, then you get that, roughly speaking, after a trade, the jump in the posterior of the market maker is going to scale with the square of the spread. Right? So now that's going to be the variance impact of one trade. In general, maybe if I'm looking over some period of time, I'm going to have many trades, and we're going to assume that the number of quote unquote trades here or bets that are arriving, they scale with the observed volume according to some function nu of the observed volume, and we'll try different functional forms and fit. So before we had a channel that arised from a probability and martingales and statistics, here we have a channel that's being driven by adverse selection, and the inputs here are really the volume and the spread. And so this is our overall model. Our overall model is to sort of combine these two, have one term that comes from sort of a deadline resolution, have one term that comes from adverse selection, and then have one free parameter, this parameter k, which is going to relatively scale the two terms. So that's the model. Okay, so how does this model work out? Well, we took about 4.5 years of data from Kalshi. We took sort of hourly observations, and in a causal way, basically based on the past, we try to predict the variance of the next hour price innovation, and we do it in a out of sample kind of way, in the sense that we fit our model based on a bunch of data, test it on the next month, then add the next month to the training set, and so on and so forth. The way we're going to evaluate our predictions is going to be via confidence intervals. The idea here is if I predict the volatility for the next hour, implicitly that's also giving me a prediction for something like a 95% confidence interval. And I'm going to check how good those confidence intervals are. And the standard way to do that is something called the Winkler score. Right? So this is a kind of like a cost or loss function. We want to make it low, and it has two terms. The first term is the width of the confidence interval, and the idea is we would like to reward methods where they produce tight confidence intervals, right, where the upper bound and the lower bound are close. But the second term is a penalty which charges according to whether when you miss a confidence interval. So if you give a 95% confidence interval and the next hour observation is outside that confidence interval, then the second term will kick in and generate a penalty. And so we're going to look at a bunch of competing metrics according to a volume-weighted version of this Winkler score. And so here I have a bunch of competing methods, and it's a little bit difficult to read, but so I'll walk you through it. At the top, we have the standard kind of time series methods from finance, Arch and Garch models, and you can see that they really don't work well in terms of their Winkler scores. Again, we want this to be low. Archac is a competing method. It's one paper we found for modeling volatility in prediction markets, but it kind of also doesn't work as well as our methods. And here we look at just using deadline resolution plus adverse selections in terms of different forms. And the best model is deadline solution plus adverse selection, where for the volume function we use the square root of volume. And so those are the blue curves. These are structural models. And finally, the red curves are when we combine the structural models and add Garch on top of that, and then you get some additional benefit in terms of reducing the score, and the method improves. So where do the gains come from? They come from capturing exactly some of these effects that we talked about. So over here on the left panel, on the x-axis, I'm binning my observations by the mid-quote. So by the price at the time the observation was made. On the y-axis, I have this Winkler score, which again, I want to be low. And I have 3 different methods over here. I have a plain Garch method, which is the black curve. And then I have our kind of structural methods. And you can see that the main place that these methods improve, where the Winkler score is low, is the fact that they're explicitly accounting for additional uncertainty around when prices are 50-50. Similarly, if I do the same thing for a time to expiry, I see that there's improvement, dramatic improvement on the on Garch models close to expiry. Again, that's the benefit of the deadline resolution channel. But on the other hand, if I look at having deadline resolution plus adverse selection versus only deadline resolution, I get improvement way over here. In other words, adverse selection helps, incorporating adverse selection helps most at a longer term horizons. If I try to look at this across categories, we see that the results are quite variable. They're variable in the sense of the overall ability of these methods to forecast uncertainty is quite different between categories. However, structurally, they're similar in that in all of these, the winning architecture is the same, which is, again, Garch model plus deadline resolution plus adverse selection. To maybe double click on 2 of these markets, which are maybe the most different, those are economics and sports. All of these markets do best in economics and do maybe worse in sports. And if you dig into it, it starts to become clear maybe why. So here I'm looking at observations where in the next hour the prediction market moved more than 5 cents. So the price moved more than 5%. And I'm looking at what percentage of, in the light blue, what percentage of hourly observations are there. So what percentage of time did the market move more than 5%? And in the darker blue, I'm looking at what percentage of volume did occur there. And if you look at something like economics, they're kind of generally pretty close. Right? So, and the way I interpret this is trading is occurring kind of, sort of maybe a little bit more uniformly. Maybe even large moves are underrepresented in volume and so on. And if you look at sports, it's maybe the exact opposite. In sports, you have about 7% of the time, you have about 50% of the volume, right? So my assumption going in my model, in the deadline resolution model, was that uncertainty would sort of uniformly be incorporated over time. And it seems like in something like sports, that's much less true in something like economics. And I think that's consistent with the kind of results which Danning was showing. If we think about a sports game in the abstract, like Knicks versus Spurs or whatever, probably days, weeks before, there's really not information that's being leaked. Maybe someone gets injured, maybe something not. But to a large extent, the prices are static. But then once the game starts being played, the prices are wildly volatile. Right, because there you're getting like the score is actually very significant information in terms of what the eventual outcome would be. So the natural way to sort of extend this and think about this is thinking about more specific models, like sort of sector by sector and event type by event type, where you kind of factor in, maybe what is really like, do we have a sense of what is the event clock for that type of event. We also have a nice explorer, which you can kind of look at, which will bring up different historical prediction markets and show you confidence intervals and volatility predictions for our model and for other models. So I will stop there. Thank you.
Thank you so much. So you assumed that the price was a martingale,
yes,
right? But then you mentioned, it seemed like some of the things you mentioned might be that it's more like a sub-martingale from some of the things you were showing. And my natural question is then, can you find like a strong law of large numbers type results if it is a sub-martingale?
Why do you think it's a sub-martingale?
I'm asking because you were saying...
No, I don't. So it's definitely not a sub-martingale because sub-martingale would apply directionality.
Yeah.
And there's inherent symmetry in prediction markets between
see.
the yes contract and the no contract. So I would expect that in general things would be more symmetric than a sub-martingale. The reason why you might think it's not a martingale is if there's risk aversion. right?
Okay.
So if these payoffs are correlated with let's say the stock market or so on, then some of these might be more insurance type of payoffs, and the price will not be the expected value. But I think in things where you have large numbers of independent events like sports, right, then you really should expect, even in the physical measure, that the prices be a martingale.
Thank you.
Hey, I was wondering on the sports versus economic slide, I really like that breakdown. I was wondering if you had one for contract duration, because I would imagine after Danny's talk that, say, the 5 or 15-minute contracts would exhibit similar characteristics to the sports, whereas longer-term duration ones might be more like the economics.
You mean like the crypto ones?
Yeah.
Yeah,
exactly.
we haven't tried that. I mean, we have crypto as a category overall here, but I think that would be something very interesting to look at. I think there's probably a clear effect there.
Thanks for the talk, Professor. It's very interesting. I'm curious, you're actually on the right slide. You sort of separated by, I think, like industry or topic
Category.
as you looked at these markets, but then you also have maybe some like properties that could be sort of similar across these categories, like being event concentrated or having smooth resolutions. I wonder if, in a couple of years' time, if we can find sort of properties of these markets that say more about how information is released, and we are able to like cluster them in a way that's like less specific to the topic. I wonder, firstly, do you think that will be the case, or whether everything will be very specific to the topic? And if you do think it will be able to come up with a categorization that's more specific to how the information is released, what kind of categories we'll see beyond just event-based and smooth resolution as examples?
Yeah, I do think there's probably going to be different types of categories, and I think it depends on like sort of the mechanics of the underlying data generating process. Like, I think sports is the best example, where the winner of a basketball game is determined by the score. The score isn't produced until like 2 hours before the end of the basketball game. So there's a very clear physical mechanism where not much information is being generated, but then a lot of information is being generated, right? So I think you have to sort of think through the different categories and come up with models like that. Versus something like aliens, probably, again, information is probably being released at a very slow, kind of, but more consistent rate, because there's, nothing special going on like a game being played.
Thank you.